Welcome to ForexTV.com. It's Wednesday, June 17th. I'm Tim Kelly with the New York Forex Market Buzz. U.S. equity markets are bouncing back and forth between gains and losses today. European markets were down. Oil is down slightly, and gold is higher midway through the U.S. trading session. Looking at the stories making headlines this hour, cost of living in the U.S. fell over the last 12 months by the most in 6 decades, easing concern that government efforts to revive the economy will lead to an immediate outbreak of inflation. Consumer Price Index dropped 1.3% in the year ended in May, the most since 1950, that according to the Labor Department. Prices increased just 0.1% last month, less than anticipated after no change in April. This may help the case of the Federal Reserve. Federal Reserve officials are considering whether to use next week's policy statement to suppress any speculation they're prepared to raise interest rates as soon as this year. While policymakers have signaled they accepted an increase in longer-term Treasury yields as the economy improves, some are concerned at any premature anticipation of rate rises. Today we're joined by Ashraf Lady, Chief Currency Analyst at CMC Markets. Ashraf, welcome to the program. Good to have you back.
Hi, Tim. Thanks for having me. How are you?
Pretty good. Ashraf, it looks like we're in the currency markets. Everybody's paying attention to the equity markets, and it seems to be pretty sentiment-driven. We're down pretty heavily in Europe, but kind of flat here in the U.S., bouncing back and forth, as I said, between gains and losses. What's your take on where we're at there?
Basically, definitely the idea here is that the big story is, does the dollar require a marked decline in equities? Is this the lone savior for the dollar? Is substantial declines in equities? And this is the question. And then basically, we saw the Dow falling to below the 200-day moving average. Today we are seeing the S&P battling to try to stay above the 200-day, which is around 907. The FTSE did close below that. And so this reduction in risk appetite is really primarily boosting the yen. And right after that, it's the dollar. And so the yen is doing very well against everything, and it's doing very well against the dollar. And that's why, and we saw dollar yen finally breaking below, 96 and went all the way to 95.55. There's a sort of a trend line, a brief trend line support around 95.50, but really the resistance is seen around 96.30, 96.40, and I think we're likely to continue to fail above that. But it's and as what you talked about regarding the CPI and all that, I mean, here's the thing, Tim. The markets have a tendency to overshoot, and even in their expectations. A year ago today, people were talking about expecting the Federal Reserve to actually raise interest rates, the Fed funds futures, and they got that wrong. So this exit strategy is really nonsense, for lack of a better word, and I think the CPI did put that to rest. So the key thing is really next week, will the FOMC signal any new wave of purchasing long-term treasuries? This is the key thing for the dollar. So it looks like the dollar is really facing two big. The boost to the dollars right now could be whether we see further declines in equities. We have to watch Latvia, what's going on, and how that impacts Sweden, and then how that impacts the rest of the eurozone. And that could be a positive for the dollar because it's reduced risk aversion.
Ashraf, let me jump in there. Let me go back to your statement regarding whether Treasury would signal buying the Federal signal buying treasuries. Yeah. What reason at this point do they have to do that? Aren't things pretty much going the way they like them to go? Why would they be purchasing treasuries now?
Yeah, well, that's a good question. When you mean by when you said aren't they things going the way they like them to go? Well, things were not going the way they like them to go because bond yields were really skyrocketing. We saw the 10-year yield, going above 4%. Well, 3.9% testing. 4%, yes, it is down, so maybe you can say that there's no need for them to do that. Here is the thing. There is the optimistic explanation and there is the pessimistic explanation to why bond yields were up. The optimistic explanation is that the economy is showing a green shoots, and it's whether it's green shoot or it's astroturf, it doesn't matter. It depends on how we look at it. But as long as the government continues to borrow money and issue more bonds, listen, and you have to remember this, the Treasury is issuing 6 times more debt than what the Fed is buying, and the Fed is around 6 blocks away from the Treasury in the same city. And so that's not enough. Once that continues, bond yields will have to go up. This is the pessimistic explanation. More borrowing and inflationary expectations. The good explanation is that, yes, the data is becoming less bad. And it seems that, look, if you look at this is not a bond story, it's not a bond interview, but any guy who spent some time there, you will see that that yields are trying to get out of their big multi-year down cycle, and they are going to test the 5% level, or at least the 4.5% level. And the Federal Reserve is going to inevitably have to stand in the way and trying to prevent that as long as the economy remains in a recession. If we're going to see further signs, Tim, further signs of improvement in the economy, if we're going to see signs of a peak in unemployment, yes, that's fine. You can let bond yields go up. That can be justified, and the Fed doesn't need to come in and buy. But if you're going to see bad data, or you're going to see a renewed decline in the data, then that could be a problem. And the other reason, Tim, is that you don't want to upset the holders of your bonds if your bond prices go down and yields go up.
Yes, of course. And we see that they're well bid, and we don't want to jeopardize that. There's a lot of rhetoric going around about whether or not some of the BRIC nations are going to continue buying the bonds or diversify, and so okay, I take that. Let's move the discussion on to specific currencies right now. Ashraf, euro dollar right now at 138.63 was up as high as 139.26. A lot of folks I speak to are thinking that we're going to see levels back down at 135. What's your take?
Yeah, I think the key support level has been really 137.70, and we actually slipped below it earlier this week. We went, I believe, as low as 137.50. So, you can describe that not as a break of 137.70, but as someone said, you can call it a bending. You're bending that support to 137.50. I believe we will ultimately break below 137. I think that the next support is still around 136.10, which is a key retracement level. And this is really because this support to 136 is what kind of equivalent to 82.5 in the dollar index. It's also a support we're seeing in sterling around 157.80. But going back to the euro, here is the thing. Yes, you may see a big support to 136. If we break below that, we could go towards 133. But I continue to expect that the euro is going to be going back towards its all-time high in the last 2 months or in the last month of the year, and we could be going back towards 158, 159 towards the end of the year. But I think we're going to have to see a retreat. Whose interim support is around 136? We could go towards 133, but if we do that, that is likely to come along with further declines in equities.
Okay. Ashraf, you spoke a little bit about sterling. You want to speak a little bit more specifically about the sell-off in sterling today?
Yes, sterling is the poster child of risk appetite. It's been flexing its muscles left and right whenever risk appetite was neutral to positive. Now, I know everybody talks about, risk appetite is represented by the FTSE, by the S&P, by the Dow. I am looking deeper than that, Tim. I'm looking at the Brazilian Bovespa. I'm looking at the Sensex in India. I'm looking at the MICEX, which is in Moscow. What are they? Yes, these are the BRICS equities. These are the emerging markets equity. Why are we looking at them? Because these are the guys that have been occupying cash. Cash is denominated in a currency called the dollar. As these equities are really going down, then that money goes back to cash. It goes back into the dollar. So when S&P and the Dow were falling 2-3% last week, or actually were going nowhere, the dollar was not really going up. It wasn't until these emerging market equities are falling. Here's the thing: we saw that we may see the second weekly decline in these emerging market indices in as many as 15 weeks. So if we see further pullback in these guys, then I think that could upset such a risk currency such as the British pound, whose support, actually the interim support, is around 161, but the big support is 157.80. So what did I say? If I'm talking to you and we are at 163.15 in cable, and it looks like it's I don't want to say inevitable, but it looks like we are going to retest 161, and I think there's a very good chance that we're going to go towards 159. But the key support is really 157.70. Finally, the euro actually is actually breathing some room and actually is going back up against the sterling. So I think that the currency market is telling you something about risk appetite. It's taking the sterling and is ready to sell it, and that is actually a sign that we can see further retreat here in risk appetite and further gains in the dollar and in the yen.
Okay. Ashraf, in the time remaining, what's the next big event for you this week or next week? What gets your attention?
Well, it's really about the Fed, the FOMC decision. I mean, tomorrow we're going to see, we're going to see the leading indicators index in the U.S. and we're going to see the Philly Fed survey. The Philly Fed survey is expected to improve from -22 to -17. That should be interesting. You got to look at the components of the Philly Fed. You got to look at the employment component. You got to look at the manufacturing component. But then there's the N4, which is the money supply in the UK that is going to provide passing interest. There's the Canadian retail sales is going to be interesting on tomorrow. That's going to be interesting. The Canadian retail sales. I'm sorry, that's on Friday. But the key is the FOMC statement next Wednesday. Is the Federal Reserve, because here's the thing, because the Federal Reserve says it's going to buy $300 billion in long-term treasuries, and it is nearing the end of this buying spree, and I think that it's going to exhaust all of those by the end of, I believe, August. So I think come the FOMC meeting, I think it might give us some indication. Will it give us some indication of whether it's going to buy treasuries, more treasuries? And you asked me a question, Tim. You said, well, things are okay in bonds. This means we may not need to buy that. If this thinking dominates the FOMC statement, Tim, on next Wednesday, and if the Federal Reserve gives no indication that it's going to increase its purchases of long-term treasuries, then you know what we're going to see? It's going to be a very good day for the U.S. dollar next Wednesday.
Okay, we're going to leave it there. That's a good way to leave it off. Ashraf,
okay.
It's been a while. It's great to have you on the show. Hey, Ashraf, why don't you tell us a little bit about our listeners about your website?
Yeah, thanks very much, Tim. Yeah, well, it is ashraflaidi.com, and it's been around for a year, and the hits are really growing. I put weekly articles there, but I put this thing called the intraday market thoughts, which is around 3 to 4 times a day, and I put in some a brief analysis about the market, about the levels, about effects, about equities, about risk appetite, about commodities. And I also have my Twitter, which is alaidi.com in Twitter, and that's actually, we have 500 people actually following us, so that's good. I think we're reaching 499 today, so that's a good thing. So I enjoy people. I welcome people to come into the Twitter and to see the statements that I put in there, which are more on the aggressive way in terms of less formal language about the market, put in some links. But back to the website, it's ashraflaidi.com, and there's also a forum there, and hopefully we will have some nice videos from the Forex TV on the website.
Fantastic. We'd love to help you out. That's ashraflaidi.com. Ashraf, again, thanks a lot.
It is Laidi, not lady.
I'm sorry, Ashraf Laidi. I've known that. I've known you for 6 years now. I should know that. I'm very lazy today. This has been your New York Forex Market Buzz with Ashraf Laidi of CMC Markets. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on forextv.com.